In this presentation, we're going to look at a bond issued or sold between interest dates, and we're going to use the effective rate of interest method for amortizing the bond. So our example here is for a 5-year bond with a $100,000 face value, and it has 10 semi-annual payments of $4,500 each. And those payments are based on a 9% stated rate of interest on the bond, or annually, or 4.5% per period. Now, we're going to amortize the bond, and we're going to calculate its interest expense based on a market rate of 8% per year or 4% per period. Let's go down here and look at our amortization schedule. Now, the normal issue date here would be for January 1st, but we delay its issue until May 1st. That's 4 months later. And then our first payment date here is July 1st. So we've got our interest payments shown here, and what we're going to be calculating is this interest expense for that first 6-month period, and then also the amortization on it. So the first thing we have to do is we have to determine the present value here on July 1st. And how we do that, in this case I use the Excel function here where I put in the market rate of interest, or 4% per semi-annual period here, and I used 9 periods. Normally we'd go back here and determine its present value of July or January 1st using 10 periods, but by using 9 periods here I can bring in to calculate the present value here on July 1st. And then the payment here was for $4,500, and then the face value was for $100,000. So determining its present value to be $103,764. And again, that's discounting it here using the market rate of interest of 8% per year or 4% per period. And we used 9 periods here. Bring it back to the July 1st date. Now, what we have to determine is our present value when we issue it here on May 1st, and that we'll do in our next step up above. Alright, here we're going to determine the present value of the bond when it's issued here on May 1st, and also determine the interest expense for the period. So when we're dealing with bonds where we are issued between interest dates, we have to break up that interest payment amount. In this case, the payment was for $4,500, so the first 4 months represents 2/3 of the payment, or $3,000, and then the 2 months after the issue date here represents $1,500. Now, this $3,000 amount here ahead of the issue date, we actually receive from the person who purchases that bond, and then later on that person is reimbursed at the first payment date. So what we have to do here is we have to determine the present or the future value of the bond here on July 1st, and then we discount it back here to its May 1st present value. So just using the this calculation here, we take the present value of the bond that we calculated at its first payment date on July 1st, and that was for $103,764, and then we add the payment amount here of $1,500. So we get a future value here of $105,264. That's its future value. Now we discount that back here, or we calculate it using the present value function. So where we take that future value amount here of $105,264, and we divide it by 1 plus the interest rate to determine $103,878. Now this interest rate here is determined here by allocating it over this 6-month period here. So we have a 4% market rate of interest for this period, and we take 2/6 of it, so that would represent the 2 months, and we come up with 1.33% here. Now we could also determine this present value here just using an Excel function. So we put in that interest rate of 1.33%, 1 period, and then we know what our future value is here through this calculation, and we can calculate it back, using the Excel function. Now to determine our interest expense for the period, we take the present value here of May 1st that we calculated, and we take it times the interest rate for the period. So we have the future value, or the present value here, of $103,878 times the 1.33% interest rate, and we come up with $1,385, the interest expense for the month or period. Okay, here we'll complete the amortization schedule for this bond. This is where we calculate the interest expense for each payment, and then we also calculate the amount that we're going to amortize that bond for each payment. And this amortization amount here reduces the carrying value of the bond, such that when we start here at $103,878 at its issue date, by the time we get down to the last payment here, the book value will be $100,000, or its maturity value on that bond. So let's look here at our first payment here on 7/1. So we had our interest payment of $4,500 to the bondholders, and then we calculated our interest expense here by taking the present value at May 1st of that bond, $103,878, times the interest rate for that 2-month period, which is 1.33%. So we got $1,385. Then we come up to this amortization of the bond premium. Well, that's really a plug here between the interest expense that we have of $1,385, debit that amount, interest payable for $3,000. Now that's the amount that we have to pay back to the bondholders at that first payment portion that they paid to us originally. And then we have our cash payment here, a credit amount of $4,500. So the premium amortization here is really the difference between the debits and the credits. Now, just looking here at this premium amortization amount, that you just take $103,878 and you subtract that amortization amount here, and then you get its present value at that first payment date here of $130,764. So now to calculate our interest expense for the next period, we take the market rate of interest for that period times this beginning balance here of $103,764, and we have an interest expense of $4,151. Now taking the difference here between that interest payment of $4,500 and the interest expense, we have the amortization amount. Now this amortization amount here of, in this case, $349, it gets subtracted here from the bond carrying value of $103,764, and we end up with a new book value here. Now this new carrying amount here gets, again, we just repeat this process here where we take the interest market interest rate for that period times this carrying value, and then we determine our interest expense, and then keep on going here. Just subtract that interest expense from the interest payment. We come up with our new amortized amount. So that's how we'd amortize this bond here, and we'd calculate its present value when issued on May 1st, and then determine the amortization schedule with the interest expense and the amortization of this bond premium. All right, to record this bond on the balance sheet, at the issue date, we'd increase our bonds payable by $100,000, and then our cash account would be for $103,878 here. That would be the present value at its issue date. Now we'd need a balancing account here, and that would be a premium to bonds payable of $3,878. Now looking back at our cash account, we also received $3,000 from the bond purchaser. That would be that portion of that first payment. Then for each interest payment, we record or reduce cash here by $4,500 plus the $100,000 when the bond becomes mature. Now the premium amortization account here, the first portion of first payment would be for $115, and then we'd amortize the remainder down here such it would have a zero balance in this premium to bonds payable at the maturity of that bond. Now this interest payable, we'd increase it here for $3,000 for that first portion of that first payment, and $4,500 for each interest expense for each period. Now, on this interest expense, which is part of net income on the income statement, we'd have $1,385 here for the first period, and then we'd recognize the interest expense for each of those following periods.